Welcome to Upthinking Finance, a podcast that offers a unique and discerning view of economics and financial planning. Here is your host, Emerson Fersch.
Welcome to another episode of Upthinking Finance. Professor Scott Sagan once said, "Things that have never happened before happen all the time." It's my pleasure to welcome back return guest Julia Hermann, who is a director on the Global Market Strategist team with New York Life. Julia, Happy New Year. Welcome back. It's nice to see you again.
Thank you so much for having me back, Emerson.
So, obviously, trying to predict things in an environment like this can be a little difficult. And I know we've had conversations in the past, but I also think it's valuable for people to at least have some idea of what experts are seeing, and at least based on macro events. And so, let's start off as we do the 2026 economic preview of just kind of your base case, what macro level things you're seeing, and then maybe we can dive in from there.
Yeah, absolutely. Simply put, we have a quite constructive outlook for 2026, and it's based both on where we're coming from and where we think we're going. Where we're coming from is a soft landing economically. The U.S. economy is growing at, or many times, depending on the quarter, at an above-trend pace. We have had inflation that has come down, but is still above target. That's a symptom of a soft landing. And moving forward into the next year, we are expecting a continuation of what we would call loose financial conditions. Essentially, what this has meant in the U.S. is an AI boom that has pushed valuations to extremely high levels. That price action has supported people's investment accounts, but it also creates a wealth effect that is stimulative for consumers to keep on spending. So it's a bit of a virtuous cycle. We expect for that AI boom to continue in 2026, and we expect it to be supported, and for the broader economy to be supportive by a really constructive policy environment. That means modest additional cuts from the Federal Reserve, modest liquidity support from the Federal Reserve, but also fiscal support that leans pro-growth. Half of that picture is what we already know to expect from the One Big Beautiful Bill Act, which was passed last year. And the other portion of that view is based on the fact that it's a midterm year. If growth were to start slowing a bit mid-year, I think we can expect that the fiscal side of policy would come in to support growth. So when we add this supportive policy environment to loose financial conditions and to an economy that's already growing at or above trend, it's a quite constructive setup, both for real economic activity and for the markets.
So my first thought is, how do I put it? This sounds very positive and very, there's a calmness to your view. And I think, speaking to the average person, right, who's looking at the news, and obviously you have to separate things, but that seems really, and I'm not disagreeing, it's a very positive outlook, given kind of what a lot of people would categorize as just complete global chaos, in a lot of areas. I mean, how do you reconcile that in your mind? I think that's a fair question.
Yeah, it's such a fair question. When I reflect on my interactions with global investors, with U.S. financial advisors, with end clients, we as a team are being asked more and more big, scary, existential questions about how the world works and this pace of global change that we're seeing. Some of it is from the US, but not all of it is from the US. And one example, I think, is the fact that we have seen political tumult spurred by fiscal questions in France, in the UK, in Japan. So many of these questions are global in nature. In some ways, though, I think that the views mesh relatively compatibly. Where we do feel very constructive on the U.S. outlook, we actually feel pretty constructive about the global economic outlook for this next year as well. But given that the balance of risk is shifting, there are a lot of opportunities to hedge for that risk or to build bastions within a portfolio to account for the fact that there are risks involved. There are inflation risks. There are upside risks to long-term rates, in our view. There are ways to account for geopolitical risk in a portfolio, and I'm happy to talk through all of that today.
Yeah. Let's get to that. So you mentioned AI. That's always, I think, on the forefront of a lot of people's minds. And as a person who lived through the dot-com era, I kind of have this theory, and this is just based on experience. I remember, there was a point where anything with a .com after it, people would call. I mean, somebody once asked me, I need to get ants.com. I mean, there was like this stuff that wasn't even pink sheet. You couldn't find any information on it, but it had a symbol. And so there's this idea, I think, in some people's minds that, it's this bubble that needs to burst, and then the quality rises to the top, and a lot of the, pretenders. And so if you could speak to that, I mean, maybe just on the sector as a whole, but maybe if you have an opinion on how this compares or is different than, say, the last, I'm generalizing here, but the last tech boom we experienced in the country.
I am not really convinced that we're in an AI bubble. And even if we are, I'm certainly not convinced that it's going to pop on a relevant timeline for us. And for the purposes of today's discussion, that timeline's in the next year. But I actually think we have a lot more runway based on long-term research that we've done. What I think is a key distinctive factor between today's AI boom and the .com boom and bust is the fact that we're not simply operating with absolutely new business models here like we were in the .com boom. When it comes to AI, we're building on tech giants that are already giants. And here's where the rubber meets the road on that. Earnings amongst the Magnificent Seven and the AI hyperscalers are incredibly strong. We are able to prove that earnings have been the key driver of the price run-up that we've seen in those AI companies. And that's saying something because, for example, NVIDIA's market cap has increased by over 1,100% in the last 3 years. So the fact that this is an earnings-driven boom, not a valuation-driven boom, is important. But those earnings don't actually tell us anything about an AI view. Why? Those earnings don't come from AI right now. They come from existing profit centers among these existing tech giants. It's what these companies are doing with those earnings that drives the AI view. What they're doing is they are taking all of that operating cash flow and they're parking it in capital expenditures, physical investment that more overwhelmingly than not is going into AI-related CapEx. On average, roughly, we're seeing about 50 to 60% of the operating cash flow of these AI hyperscalers going into CapEx, and the majority of that goes to AI. So that is really the pipeline that we're looking at. That is the crux of conviction in the near-term Magnificent Seven and AI hyperscaler view. And I really don't think that 2026 is going to be the breaking point in that narrative. One reason for that relates back to that constructive base case that we have, including for fiscal support. The One Big Beautiful Bill Act brought back 100% CapEx depreciation and R&D expensing. These were provisions that were in the 2017 Tax Cuts and Jobs Act, but faded out in 2022 because of budget issues. The return of these provisions mean that these companies, any company in the US now, can immediately expense physical investment that reduces their taxable income. And that means that these companies are really incentivized toward physical investment, specifically this year forward. So it's difficult to imagine a breaking point specifically on the build out of CapEx.
So that's actually a really good point I have not heard, but that's usually what I'm grateful that you bring to the table because you always have a view I haven't heard. So that's almost basically what you're saying. My mind is it's effectively these established companies. That makes perfect sense. It's like R&D investment in a way. Instead of just buying back stock, they're taking the profits and building out this whole new industry. I mean, is that a simple, really basic way to put it?
I don't think that that's an unfair comparison at all. These companies are taking a risk. They are, right? We know that they are still working out how to monetize their AI capabilities. We are so early in AI development, and so we don't know how many foundational models we'll have in the end. We don't really know how to monetize the applications 100% yet. So yes, it's a risk, but arguably these companies were already of the size and scale where if you were going to pick a sector of the market to take a risk of this size, it would probably have been those tech giants.
No, that makes perfect sense. No, that's great. Well, thank you. Awesome. You mentioned the inflation risk in the beginning, and it's hard not to go into that without getting into geopolitical stuff. But let me ask you this, because you refer, and I've read this in a couple other places too, about really staying off the long end of the bond market. So, there's been a lot of commentary and just people are seeing concerns on, the 30-year, the longer term, and stay short to, protect principal. What's the roots of that for your view?
Yeah, absolutely. So I'll just be honest about it. We saw these upside risks in long-term U.S. interest rates, so the 10-year onward, all throughout 2025. And our view was to be cautious on adding duration because of those upside risks. And we were wrong. We saw a sustained rally in long rates all throughout 2025 in the face of mounting risks, whether they were geopolitical or about the pace of policy change, even through that period of tariff indigestion in the spring, through fiscal sustainability issues. There's also a more positive component to higher long rates, which is higher growth. And growth has been really, really resilient. So that's another piece of upward pressure on long rates. But despite this, we saw rates come down. We're sticking with that view, though, for 2026. We see all of those same upside pressures. Our view on growth has actually moved more constructive. So we see both risks and more positive reasons for long rates to potentially move higher next year.
The Fed, I know we didn't really talk about this, but I know saw a piece that came out from your company, I think actually just yesterday, and it was kind of about the whole independence issue. And I mean, maybe the question I would say is, so if I'm remembering right, current Fed Chair Jerome Powell's term is up in May. Is that right?
Yes.
Does that impact your view on things? And maybe an add question to that too is, because there was a comment in there I thought was kind of interesting about how the Fed chair delivers the news, and there's so much nuance put to, every word that's used. I mean, I've seen on one blog where they'll take a speech from before, go to the next one and redline. And, I mean, it's almost a little creepy. And it kind of started, at least from my career. I don't remember the Fed being so much of a focus until Greenspan, and you'd see him walking across the street. I mean, this guy was like a celebrity. So how does that whole dynamic impact your guys' views, if I can ask you that?
Emerson, I'm so glad that you did ask me about that, because one of the most common misconceptions I'm hearing from global investors of all kinds is about the impact of a new Fed chair on Fed policy and on Fed independence. I will often get questions that start with a premise of, okay, so when a new Fed chair comes in and rates move 200 basis points lower, what happens, right? The simple answer is that, number one, we don't expect that the Fed is going to lose its independence, particularly within the next year. And a big part of that is because the Fed chair is influential, absolutely. But they do not have sole discretion over any monetary policy tools that the Fed uses to keep prices stable and employment maximal. They need to have a majority of voting members of the FOMC, which is the committee that sets interest rates, or the Federal Reserve Board of Governors. They control things like bank oversight. They need a majority of their colleagues to agree with their decisions. So that comes down to influence, not absolute control. What the Fed chair does control, as you mentioned, Emerson, is communication. And I love your point about how Greenspan sort of really put his personality on the Fed. And I would argue that, Volcker had a very personality-driven Fed as well. These Fed chairs do put their stamps on their tenure, certainly, and a lot of that is through communication. We need to think back to 2010, 2011. At that point, the dot plot didn't exist. Press conferences didn't happen after the Fed met. It was Bernanke and Yellen who together agreed that they were going to implement that transparency after the financial crisis. And with a new Fed chair, look, we could have someone who wants to remove that guidance and remove that transparency and not do press conferences anymore. It's possible. We could also have a Fed chair who wants to put a camera in the meeting room, right? That transparency, that communication is not policy in and of itself, but I think it does dovetail with the reality, which is it's all about market perception. The market tends to like to have quite a lot of information, and yes, we obsess over that information probably a little bit too much, but they like to have transparency, and the market needs to know that the Fed is credible in its ability to fight inflation long term. So as long as those two elements of perception are maintained, I think that the questions of Fed independence will not feel quite as immediate for 2026.
That's really good that you explain that, because I think, people hear President Trump yelling at Powell as if he's gone, somehow things are going to change. And exactly as you explained it really is a lot of noise, because at the end of the day, it is a committee type of a structure. So no, that's great. Is there certain measures or indicators, especially in light of a tariff environment, that you just have had to let go of? Maybe that's the question, is moving ahead. Yeah, I'll stop with that.
Yeah. It's a great question, and I'm getting a lot more questions like this on, is the data reliable? This pertains to how the Bureau of Labor Statistics applies their methodology to give us various kinds of data. And the reality is that, at least for now, what we've been able to observe is that any revisions in data, any inconsistencies in data, have come from very reasonable methodology reasoning out of these statistical agencies. So in general, we haven't had to necessarily abandon any specific types of data. We did get a bit of and by we, I mean investors of all kinds, we got a little bit of a crash course into having to look into other data sources during the government shutdown, in which official data wasn't being published. And we learned after that shutdown that private and therefore more limited sources of information, whether that's on the labor market, for example, they are more limited, and therefore they don't present quite the holistic picture that official government data sources do. Now, in terms of the impact of tariffs and on tariffs, we are able to look through government budget figures what tariff revenues have been for the full year. So in that sense, we have a pretty good sense that they're in the low hundred billions. What is so curious, though, about the general tariff situation is the noise. We know that the Supreme Court is going to rule on the use of IEEPA as a legal authority to impose tariffs. That ruling was expected maybe yesterday morning on January 20th. We didn't get it then. It's expected any day. We also know that, in line with the president's comments at Davos, that the tariff situation may change further. So I'm not sure it's worth going through the game theory of what tariffs will look like 3 months from now, because there's both legal and political considerations there. What we can focus on is, what has the impact been? We know that so far revenues have come in. They have helped the budget, but extremely modestly. We also know that tariffs have helped to drive a choppy 6-7 month uptrend in goods prices. And we know that they've contributed to transport and logistics costs becoming more expensive. These shifts in costs have not been game changers for inflation in the way that they were initially feared in particular. But we get too relaxed, too comfortable about inflation risks at our own peril as investors. And so we've been having to consider potential portfolios exposures that can help us account for upside inflation risk. That can range from things like commodities, satellites, to gold exposure.
No, that's great. So, and maybe just, you may have already answered this, but just to make sure, I mean, how do you, because you've just mentioned some things that have gone up, yet inflation's gone down. I mean, how does that happen?
Yeah. So inflation, as we know, is a broad basket of things. And the reality is that pure goods prices aren't that huge of a component of the basket. So even though we have seen core goods prices move in that choppy uptrend, they aren't the majority of what we see in the overall data. The key driver of CPI, Consumer Price Index inflation, is shelter, aka rent costs. And this has been evening out recently, but it is about 45% of the inflation basket, and its pace of growth has still been elevated when you look over the last 6 to 12 months. So inflation ultimately really is a housing story. The other side of things is that services costs have been mixed. Those are another big chunk of the basket. And then finally, energy. Energy prices have been coming down. They've actually been really helpful to inflation figures over, I want to say, the last year or so. So quite a literally mixed bag, or mixed basket, I should say, on the inflation side.
Yeah, gas here in southern Utah is under $3 a gallon. Sorry for all you California listeners, and probably you listeners in New York. But anyway, no, that's actually a really good point, and just a lesson for people is, again, you mentioned the term, there's a lot of noise, but understanding how these things are calculated and determined really can diffuse a lot of confusion. Like what you just explained, yeah, these certain things may go up, but how much do they really impact, the overall picture? So,
and look, the reality is, Emerson, that there's still quite a lot of affordability issues in the US. And even though I, as an economist, can talk about the pace of inflation being relatively more moderate recently, that just means a relatively more modest pace of price growth on top of elevated price levels, right? And so for the many, many Americans who are still certainly feeling that affordability is out of reach and that inflation is still a problem, it's because of the price levels that are not coming down. The tough thing, too, is we arguably don't want to see price levels come down across the board in absolute terms, what we would call deflation, because that might mean that we're in something like a recession, right? It means that we have even bigger economic problems. And so what is so important, I think, for us to validate on the inflation side is just how persistent this feeling is likely going to be.
No, that's a fair point. Okay, so can we jump into geopolitics? I've got a bunch of questions, or at least things, and this is one I didn't mention, and everything is so connected. So the whole thing with Venezuela, and without getting into the politics of it, but just really, is it, some say it's an oil grab, others say, it's a positioning, because China has a foothold there, and there's this goal to try to control the entire Western Hemisphere, in a sense. But I mean, how does that impact the energy markets for, a person in your position? I mean, how do you see that playing out globally? And ultimately, I guess, is that the reason why prices are going down more, or, what's the impact?
Sure. So the simple answer is that prices have been coming down because supply has already been higher. U.S. production has been expanding, and that has been a really key driver of energy prices coming down. Now, in theory, Venezuela that is able to export more oil, specifically the type of oil that is easily refined in U.S. Gulf refineries. In theory, anything that expands supply can contribute to costs coming down. It can also help shift the balance of supply away from OPEC-related producers and into the Western Hemisphere. And that may mean that we have a slightly more segmented energy market, but at this point, that is all speculation. In general, we see a few different pressures that could contribute to oil going perhaps closer to $50 a barrel at some point, but we need to consider one key break on downward pressure on oil, which is that at some point, there's what's called a break even. The price at which it is no longer profitable to pull oil out of the ground. This applies to U.S. producers, to Venezuelan producers, to any type of energy producer. And so there is a clear working range of prices. Ultimately, what that means is that even if we see downward pressure, we're probably talking about relatively modest adjustments here. And we're probably talking actually more about price stability rather than a clear descent in overall energy costs.
Do you have a number on that? I somehow remember $30 a barrel being the break even, but I maybe that's too low, or was it 40, or do you know, or is that just kind of a moving target depending upon a bunch of different things?
It's a moving target, not only within the U.S., but pretty much every major oil-producing economy has their own fiscal break-even price for oil, meaning that they assume a minimal price for oil in their own budget calculations for their overall economy for the year. Those change annually, and they vary dramatically based on the oil producer.
Okay. Yeah. Cool. All right. So Japan, So I'm going to share with you. I mentioned Russell Napier. He's somebody we subscribe to, and I've always enjoyed reading his views on things. And he's had this theory, on Japan with the never-ending QE that's gone on for decades. And yesterday, the recording today is January 21st. This was yesterday. Saw a huge bump up in yields, and his theory, and I'll just summarize it, is effectively that they've got to control that the government cannot continue at this point the Bank of Japan cannot continue to buy these bonds and keep rates low on their own because of that's just an inflationary risk, and their currency's already trading at really, the exchange rate's very, very low. So his theory is that there's going to be what he's referred to as financial repression, which is effectively local savings institutions, and he's also thinks France is subject to this, and this could be almost like a bit of a plague, I suppose, or a virus, however you want to call it, spreading to a number of countries that have these really high debt to GDP ratios. And so the theory is that at some point, these savings institutions are going to be forced to start buying bonds, or they're going to have to sell down assets. Well, what are they going to sell down? We're going to start selling down foreign governments' holdings. And the number in my head that Japan has in terms of U.S. securities, somewhere between 60 and 70% of their portfolio is invested in the U.S., either directly or through Cayman Island accounts. And so this, and what I'm bringing this up, and maybe the broader question here is what do you see for headwinds? Because, you laid out a positive outlook, which I think is that makes sense to me. But there's this idea that potentially if countries start repatriating their own money, maybe that's the question. Do you see that? Is that a risk? Is that something that ever comes up as a possibility? I mean, I know in all the time I've been in this business, what happens when they start selling off U.S. debt? I mean, that's been a fear for years. Yeah. So there's my question. I'll stop with that.
Yeah, absolutely.
Does that kind of make sense?
Absolutely, it does. So look, Japan faces, in probably the starkest terms, a trade-off that is being faced by almost every major developed economy right now, which is a tension between wanting to spur growth, wanting to deliver on fiscal spending and fiscal stimulus, but facing big, bad debt issues, especially when you consider the long term. Japan is in this situation in the starkest terms because its growth has historically been lower, its demographics are worse, its inflation levels are worse, and it has the largest pile of debt in absolute terms. But the U.S., as we know, is facing this same issue. France is facing the same issue. The U.K. is facing the same issue. And even though it's coming from a very healthy fiscal starting point, German long bond yields have actually been rising simply because they're being willing to spend more. It's not necessarily a negative signal from the market, but it is a sense of, okay, everyone is starting to think about spending more on infrastructure, on defense. Everyone's trying to support their consumers in different ways. And no matter which way you slice and dice it, that means more spending. So many nations are facing this very stark trade-off. And in Japan, the stakes are very high for many reasons. First of all, the Bank of Japan is the most utilized central bank in the world. It owns over half of Japanese government debt in total. It has a small role in the equity market. And when the Bank of Japan has been trying to normalize policy, which really means allowing rates to come up above zero, which they've now certainly done, it means stepping back from their role in buying Japanese government debt. It means gradually unwinding equity positions. When the Bank of Japan has been trying to do that, it's been met with significant pushback from the market because the Bank of Japan is such a huge source of demand for Japanese assets. The other side of this is that, yes, in the time that Japan has most recently used QE, they have been able to now raise interest rates, normalize them a bit. They have seen growth recover. They have seen inflation come in the post-pandemic period. But in the last quarter specifically, growth was weak and inflation was weak. And so Japan's experiment with reflation is still a tenuous one. And one would argue that financial repression, which really needs quite a bit of inflation to be present in the economy, isn't a for sure thing for Japan yet, because they have been using some form of QE for well over 15 years, and we haven't seen significant inflation from them except for in the past few. So with Japan, I think especially from the perspective of U.S. investors, there's concern that if Japan makes their interest rates more competitive, Japanese investors, Japanese corporations, and even the Bank of Japan itself will reallocate that money to domestic Japanese securities as opposed to things like U.S. treasuries. The good news is that no one country, China and Japan included, have enough power to single-handedly destabilize the treasury market with selling. Yes, there was a response in both U.S. and Japanese government yields on January 20th when we saw a new spending plan come out of the government, but nothing that would truly destabilize markets. So we will be watching Japan, certainly. We'll be watching how the market digests the spending plans of the new government and the snap elections of the new government. But I am not concerned that repatriation of money is going to destabilize treasuries or destabilize dollar demand.
No, that's great. And why? And you said that there's not enough. My words, influence, or they don't have enough ability to impact the treasury market. Is that just because of the liquidity of it, or just because they don't have it as a percentage of total, outstanding debt? It's really not as big as maybe a lot of people think.
Yeah, it's a function of both ownership, and Japan does not own more than 10% of U.S. treasuries. I'd have to double check on my exact figure. It's both a function of ownership, but also liquidity. If the U.S. were to face basically a big wave of Japanese investors allowing their treasury exposure to roll off, the way that the U.S. Treasury would deal with that anyway is to issue auctions of new debt to replace that debt. And this is happening gradually again as treasuries mature. And so due to the incredible liquidity of the treasury market, there is a lot of reason for us to feel confident that other investors would step in and that overall demand would not change.
Is there truth? I just thought of something while you're explaining that I mean, at the end of the day, all, the noise aside, the U.S. markets, I mean, it's kind of like, I mean, this sort of sounds like an arrogant statement, but it's okay. X country, you're going to pull your money. Where are you going to put it? I mean, where are you going to put it that is really as safe and liquid as the U.S. bond market? I mean, is there some truth to that?
Yeah. It's the concept of TINA. There is no alternative to the relative safety and liquidity, and now quite a competitive yield on U.S. treasuries. I will say, though, even though that really helps backstop structural demand for treasuries, it's a key portion of why U.S. debt might not actually be all that unsustainable right now. In general, when we're thinking of allocation, investors that are solely focused on safety are giving up quite a lot of yield generation potential in their portfolios. And so that's why we're really encouraging investors to not be part of the $8 trillion in cash that we see parked in U.S. money market accounts right now. The yield on that cash has come down significantly by 175 basis points on the front end as the Fed has eased in the past 18 months. And so we're really encouraging investors to consider steps out of both sovereign credit and into corporate credit, and some steps out on the yield curve.
Here's something that would be really helpful to explain. That you just brought up that's really good, and it's simply why you can see rates, we've talked about going up on one end, yet bank rates go down, and how do you explain that dynamic to the average investor who's was happy with CDs when they were paying 5% a year and a half ago, and now they're down to 3.5% and still dropping.
Yeah, the simple difference is what the Fed is able to pretty much directly control via the policy rate on the very front end of the curve. That's the overnight lending rate. It heavily influences the rate that cash receives in money market accounts, for instance, versus rates that are determined by the market. The 30-year mortgage rate, for example, is a market-determined interest rate. And we can talk about the level of correlation with the mortgage rate between the U.S. 10-year Treasury and the 30-year Treasury, but the reality is that this is a market-determined interest rate. So simply put, the Fed can heavily influence the cost of money, but it cannot determine the cost of money specifically as you get into longer and longer term lending. And that includes both the Treasury curve, where we effectively have interest rates on that set at every new auction. And the total interest rate there is the sum of what's happened at every auction over time for that tenure. And then we have purely market-determined interest rates, like mortgage rates, like credit card interest rates, like auto loan rates. That's
actually a great answer, and another reason why, to the point of the Fed's scope, it seems so broad, but at the end of the day, there's still limits. It's not one person or even one entity or institution that controls things. So that's good. So last thing, China. So, again, my limited, knowledge here is it's obviously there seems to be some kind of a policy of isolation going on. I know that some of the analysts we follow have said, keep your money out of there because there's a likely that it could get frozen, similar to what happened to Russia. And so, but there seems to be a tie to China, trade markets, their access to, oil in Venezuela as an example, and commodities, and perhaps some of these other countries. Just a broad view on that, because I know it can be pretty complicated. It sort of as maybe the last point before I let you get back to work.
Yeah. China, I used to work in emerging markets investing for 5 years, and that's basically a China-related job. And with China, I see a little bit of a divide in terms of view. China is one of the most important economies in the world. Its version of maintaining a more modest growth target is to maintain a 5% growth target. And so questioning the economic engine of China, I think in so many ways, is a fool's game. Even though they have these structural leverage issues, China is certainly capable of churning out growth. It is very capable of naming national champion industries and pouring money into them in a way that really allows them to become a market leader. The most recent example of that would be electric vehicles. And the next version of that is likely going to be AI. I'm not actually convinced, this is an aside, but I'm not convinced that US-China competition on AI is a bad thing. I think being innovative about ways to bring down energy costs, for example, could be something that is beneficial, even if sharing the actual fundamental model technology isn't going to be possible due to censorship and data restrictions between the two countries. But in general, China is an incredibly important economic powerhouse. But especially from the perspective of U.S. investors, the way to get access to that in the markets is indeed relatively limited. That's because foreign investors don't tend to have access to the onshore Chinese market. And even if we had access to it, it wouldn't necessarily be my favorite pick in terms of finding a free market-driven stock exchange. Back to that national champions idea from earlier. One way to access China is via the Hong Kong exchange. This will be a mix of domestically driven, Chinese economy-driven stocks plus some tech exposure. And in the U.S., we have American-listed Chinese tech stocks in particular that have allowed Americans access to those names. But that's subject to regulation, both in terms of what China is willing to allow and what the U.S. is willing to allow. So access vehicles to this market are limited. One way to think about Chinese exposure more broadly is to consider the role of emerging markets. Many of those economies are more exposed to China at this point than they are to the U.S. But with emerging markets as a whole, we need to consider that emerging market growth tends to be derivative of global growth. And so in a time of great liquidity, global expansion, emerging markets will tend to benefit. But in times in which global growth is slowing and liquidity and policy are contracting, emerging markets will tend to feel that pressure even more so than developed economies.
No, that's great. So before I let you go, any final thoughts, any just words of pearls of wisdom that we haven't covered? And I feel like we've covered quite a few.
I'll land with just a few themes that we're seeing in portfolio construction that I think are worth noting because candidly, they haven't paid for the last 15 years, but we think they're going to start to. Those two themes are diversification and quality. Diversification and quality fell by the wayside in the lower for longer era post-financial crisis, and they also didn't necessarily deliver post-pandemic when everything was just subsumed by lower interest rates. But even though we have such a supportive policy environment and a very supportive, very constructive outlook for 2026, we have to acknowledge that we're starting to get later in the economic cycle. We're starting to get a little bit more mature in the credit cycle. And that means that things like being very selective in your opportunities, having really strong underwriting practices. Some of this is very much tied to active management. Some of it is simply a quality pick at an allocation level. But we believe that these two themes are going to start to be better rewarded in the markets in 2026. And this applies across asset classes and also across geographic diversification.
No, that's great. It's always great to hear, fundamental principles that made sense are back in vogue again. I was actually lamenting to Amy, you met her, my partner, about just how, gosh, now I just lost my train of thought, but we were just talking about how, risk management. Oh, you get far enough away from 08, 09 and, risk and the potential downsides of things, it starts to wane, people start to forget, I don't know what the time frame is on that, but sometimes, those ideas of just, diversifying, spreading out your risk, sometimes, in favor of just chasing the hot thing, which is always dangerous. But anyhow, I want to thank you for your time. I always appreciate your insights. You just see things a lot differently, and I feel like we just covered a lot of ground in a very short amount of time, which is great. And for people who want to connect with you on a more frequent basis, the podcast, I should have had this out, but where is the podcast, your weekly podcast, located?
Yes, our podcast is called Market Matters by New York Life Investments, and it's available wherever you get podcasts, on Spotify, Apple Podcasts, and more.
Market Matters. Perfect. Julia, thanks so much. I'll let you get back to work. Have a great day.
Thank you so much for having me, Emerson.
Emerson Fersch is a registered representative with and securities offered through LPL Financial, member FINRA, SIPC. Advisor services offered through LPL Financial, a registered investment advisor and separate entity from Capital Investment Advisors. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. The guest speakers and the companies they represent are not affiliated with or endorsed by LPL Financial or Capital Investment Advisors. Individual tax and legal matters should be discussed with your tax or legal expert. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.